My name's Duncan Craib. I'm the CEO and Managing Director of Boss Energy, which is ASX listed. We're the 100% owners of the Honeymoon uranium mine located in South Australia. And we're also 30% owners in the joint venture agreement with Encore with their Alta Mesa mine in South Texas.
Duncan, good to see you. So it's been such a long time. Obviously been following you keenly. Wild ride, the uranium space over the past 5 years. Still standing and producing now.
Matt, it's been quite a journey. It really has been. But I guess we've been fortuitous with timing the market, bringing Honeymoon on at the right time and doing that sort of joint venture arrangement with Encore Energy and the Alta Mesa mine. But yeah, boy, there's volatility in the market. But yeah, we're just pleased now to be in production and have two assets that are going well, actually, and now shipping uranium. So yeah, what was a sort of dream 8 years ago has now come to fruition.
Well, let's talk about the business plan, because I think a lot of your peers or people who were your peers took a different route. They aren't in production. They're going through a process of waiting for price recovery, price discovery in the marketplace. What enabled you guys, and what drove you guys to actually say we need to get into production as soon as possible?
It was somewhat incumbent upon us really as a restart project that you've got the infrastructure available. We're really well progressed with our permitting and licensing. So we really were like the next cab off the rank, so to speak, after the existing producers to come online. So we had that first mover advantage. I think one of the big challenges one has as a developing company with large capex is that you're either going to raise your finance to build the mine through either debt or equity or a combination of both. And if you're having a large debt component, then the financiers will look at what contracts you've entered into. And in our market with uranium, the way the price is heading, we tend to go for market-related contracts with a floor and a ceiling. And the financiers will only look at the floor. They're not going to take into account what could possibly happen to the ceiling. So right now you're looking at floors of, say, 70, 75 US a pound. And quite frankly, that as an incentive price isn't high enough for new development projects, particularly if it's large capex. Effectively, you might be signing up the first 3 or 4 years of production and tying that into the low price. So that incentive price isn't there for other projects. Whereas restart project like ourselves, it's in situ recovery form of mining. We've adopted ion exchange. It's just cheaper, large. We can put more production throughput through the mill effectively and produce at a lower cost. So we had that advantage. So rather than wait for all the other development projects to come on and compete for contracts, we thought, let's go now. Let's take a view on the market. When we announced FID, it was around 45 US a pound. So, and we needed 60 minimum, but we thought in 2 years' time, the market will be there. And fortunately it is. So yeah, our timing was right, but I'm a big believer. If you believe the price is going up and you've got conviction in your project, don't wait too long. But I'm sympathetic that if you've got a large debt component, you don't want to sign up too much of your mine life too early.
It was interesting times, geopolitically. Obviously, you're right in the middle of kind of COVID as well, create kind of sort of supply issues globally as well. It must have kind of given pause for thought for the financing side of this thing. Because if I'm a financer, which I was, you're looking at, okay, it's a former producer, albeit, and it started up in the 70s. It's a ISR, it's cheaper, I get it. But I'm still probably thinking, well, is the market going to be there post-COVID for this thing? So in terms of those conversations you're having, what were you having to persuade people to give you the money, or were they already there?
Yeah, no, they weren't already there. COVID was stressful. It was which way is the world heading? To be frank, if it wasn't for the Sprott Commodity Trust coming into play and soaking up some of that inventory, the uranium price, I don't think, would have moved to how it's got to the current highs. So when I look at the sort of three big movements, macro, it was really the Sprott Commodity Trust coming in, when was that, around 2019. Then he had the COVID years, which then put gosh, where's that new supply going to come from? It's sort of inhibiting new projects getting off the ground. And then, of course, you had Russia's invasion of Ukraine, which then brought all that new geopolitical tension. But, unless those three catalysts had occurred at a macro level, you do wonder how the market would be performing currently. So, those three things really have helped our cause, really.
Yeah, I think I was kind of wondering what the kind of synthetic financial overlay of a stock.
So in terms of how it was in terms of getting buyers and people interested in the stock.
Yeah.
It's really difficult. I mean, I'll tell the story when I returned from Namibia to Australia after, 16 years, but sort of 5 in Namibia. And we did our first roadshow, and the only black shoes I had were the ones I got married in, these thick sort of things off German Street. But blisters aplenty. And then I switched. I learned that you can actually get these shoes skippy. They're called skippies, kangaroo sort of leather. Well, I'd worn out 5 of them by COVID. You just were walking and pumping the street. Brokers weren't taking interest in you, and it was really tough to get an audience. What changed were suddenly a few new players appeared, so funds. You had the likes of, in the US, Sachem Cove, Segra were one of the first to the sort of new money coming to the market. You had the likes of Paradise and some high conviction funds in Australia. And it's really those that really took a longer term view and said, right, we're going to get behind BOS, as they did with other uranium developers for sure, and took that longer term view. But without them, it was really tough. And, really, while we feel like a bit of an overnight success, it's been years in the making to get to this point. So, long journey.
Yeah, a long journey, and we are where we are. I'm also interested in some of the decision making along the way, because it kind of helps inform the way you're going to view things, going forward. So this kind of first mover advantage was hard won, quite frankly. Is that what you're saying?
It was hard, and going back, one of the things we identified, or I was aware of, having been in the life cycle, was a lot of talent had left the industry, so a lot of technical talent. You then sort of, when you do your feasibility studies, typically you then saddle up with an engineering firm to give you that sort of external third-party views. We found that while they're very capable people, that industry experience in uranium and processing plants wasn't there. So we set about, gosh, we've got an advanced asset, it's a restart project. Why don't we now quickly try and grab that self-performing owners team? So we set out and recruited some really people who had been involved in uranium, who had the skills, and that also set us apart. But once you start getting people like that within your company, it's almost obligatory to keep going and say, look, this isn't another feasibility study. We are going to get traction. We are going to raise finance. We are going to go into a project mine build, and to keep their bums on seats and keep them engaged. So it started this self-perpetuation of, okay, now you've got your people. Suddenly uranium price started ticking up because COVID, etc., the Sprott, Ukraine, and then it just sort of self-propels, and then it's really timing the market and saying, when is there interest? And as we've seen how cyclical uranium is, even there's short cycles, it seems to be 2 or 3 times a year that we get this huge run, and you wake up in the morning and the screen's green with share prices. But, you look at, suddenly there's a lot of interest in the sector, and generalist funds are becoming interested, and you sort of want to, encapsulate that and say, well, look over here, we're just about to get going. And fortunately, we've been lucky with some of that timing, and we've been lucky securing some good funds and shareholders that took that long-term view.
Okay, and I've spoken to lots of uranium companies, most of them along the way, and some are obviously got lots of exploration, as you expect. Not so many developers, and they're all at kind of varying stages of advancement there. But what is clear, there's a lot of companies who understand the theory of doing this, having not done it before in uranium, and quite frankly, some of the teams not having done it before in any metal. What were the things for you that were important to get in place? I appreciate it's a restart, but what are the things that you recognize and you had the team address to allow you to get to a point where you can get into production?
I think it's twofold. For us, it's really one, stakeholder management. So finding good shareholders, so you need that financial support. But it's also other stakeholders. It's the traditional owners, it's the Aboriginal groups in Australia that one has to really work closely with, and sort of, it's their country where we operate. So getting their buy-in and alignment was very important. It's them working with the state government, and in Australia they've still got this archaic view towards uranium, towards nuclear, and in some states uranium mining. So really getting government support. And on the other side of the equation is then building up your credibility with fuel buyers, with utilities. And unfortunately, in our situation with Honeymoon, the fact is that it had gone into care and maintenance. It had closed down, and a lot of utilities were questioning the viability of the project. So we had an effort to do there. We had to rebuild their trust and belief. So, it's really a journey, multiple levels, trying to keep all these various stakeholders interested to get it going. But had I had my time again, Matt, I wish I'd sort of maybe recruited more people around me to help, if you've got that conviction, to help you through that next stage. But again, we were sort of cash poor. It's not like there was a lot of money going into the company. It was really trying to, I call it like campaign style funding. There's suddenly momentum in the market. You know that you need to do an exploration program, or that you've got a feasibility study coming up. So you sort of raise money as and then, and you do that, and you prove that, okay, that was success. Then you go again and again and again until, fortunately, the last few years, the whole market's lifted tremendously.
Right. Yeah, I'm sure we could do a little deep dive on that financing process, managing cash and managing expectations. And I saw that phrase campaign style in one of your marketing documents. I was going to ask. But I think most people understand what you mean. Let's kind of maybe jump forward a bit. Maybe if we see you again, we can maybe get into some of these in a bit more detail. But let's move forward. Like you're producing pounds. You have term contracts in place. So let's look at that side of the money equation. You've got to pay back all of these, all this money that you've borrowed till now, all this money that you've raised till now to get to where you are. Producing pounds is the way to do that. So what are you producing? Who are you selling it to? What are you selling it for? Is the money flowing?
So I guess, we're fortunate. We took that view back in 2018 to raise money to buy that physical uranium. So we bought 1.25 million pounds at, I think it was 30.15 US a pound. So that's provided us with a working capital sort of float to get us through this next few years and onward, really, and provide, that buffer that I think every producer needs to take into account the 3 or 4 months to ship material to the conversion facilities. So, yeah, we built that facility. We're zero debt, we're debt free, but we have raised significant capital from the equity markets. And by repaying, absolutely, we want to repay our shareholders with capital growth and eventual dividends. So that is the goal. But in terms of contracting, we've adopted a different strategy. I guess we sort of look at ourselves as being nimble in the sense that, we're a sizable producer, but you put in perspective, we're ramping up to 2.45 million pounds. It's not like Alesa, where I was, which is now in excess of 10 million pounds per annum. By being nimble with 2.5 million, you can do a combination of being largely spot-related sales rather than commit all your resource into long-term contracts. So roughly, we're about 16% contracted now, life of mine. And so we've kept the powder dry. Why? Because we believe that uranium price has still got a lot of room to move. And principally because we see that a lot of uranium developers are not going to meet the timeframes they're suggesting, which is just going to cause that deficit to widen to a point that prices will have to increase to incentivize that new production. So we're deliberately taking our time and, like, for example, during the December quarter, sold 200,000 pounds on the spot market.
Okay. So
that's a combination.
Yeah. Okay. It's 16%. Okay. It's obviously, people look back to Paladin, what happened there, totally exposed. And, that did for them in the market, which came off quite quickly. What are the risks that you sort of see? Because you're right. companies are not advancing as quickly as they have signaled to the market. They're not producing the pounds, even the Cameco's are not hitting those numbers. You've got Kazatomprom come off, and anyway, their stuff's going east off to China. The African projects not moving at the rate they said they would, because they want to wait for price discovery, etc. If I'm a utility, I'm getting a bit nervous. It's like, are these guys going to get their act together? Do you think they're going to do anything about that? Do you think they're going to step in and actually do more than just term contract? Would they come in on an equity basis? Do you expect to see more support from on a government basis? Or do the equities say, do you know what? Right now, conventional gas projects, we'll focus on those for now. What do they do?
Matt, I do. I think that there is nervousness building in utilities and fuel buyers, wondering if development projects will come on and meet the timeframes. As a producer or developer, we're almost shot ourselves in the foot during those doldrum years of the commodity price, because we're all trying to get the lowest cost of production and could be the quickest to produce. And now we're being held to account for what we purported to the market. So, and I think the utilities, there's a bit of re-education process that's beginning to happen there. Just on another flip side or another angle, one of the things, conversely, that I'm becoming more aware of, and I guess not concerned at yet, but they're windows of contracting. And the reality is most of the utilities have contracts until 2027. So if you're now looking to contract, you're looking from 2028 onwards. There's still independent small amounts being purchased here and there, but really you have to have that forward-looking view. And if you're a developer coming on right now, to get a big contract, you're really looking a few years in advance. So managing that side of the business for me has been, it's interesting, it's complex, it's not easy. So for us, while we are keeping our powder dry because we believe prices go up, there will come a point as well when one needs to think 3 or 4 years ahead with your production profile and the competition coming in with new development projects. So yeah, it's an interesting game. And I think too that some of the new development companies may be trying to undercut the market, trying to win a contract to then broadcast to potential shareholders, look, we can do it. So yeah, really interesting game.
How have you kind of read, because you've got to have one eye in the market and say, well, how's the market reacting? Because it affects your share price, and sentiment is a big driver in the uranium fields, because people just don't understand the industry. Retail investors just don't understand the industry. I'm not even sure institutional do either, because it's been traditionally a very small sector, and those kind of key drivers were kind of quite opaque in terms of the data. So if I'm a utility, and looking at the landscape in front of me, and maybe I'm contracted to 27, 28, who knows? I've still got to have an eye on when will these guys get going, because you don't suddenly you press the green button and everything's producing the next day. It takes time to ramp up, and maybe the uranium price goes to $200-$300, which people have been calling for a long time, but it doesn't matter. There won't be enough uranium to buy.
That's
good for you.
Right.
Good for you.
That's right. I mean, there's enough. There's enough uranium in the world. It's just that higher incentivized price to develop it and bring it to the surface. But how do you go through all that permitting in a short time period? How do you get the capex? How do you get that industry know-how to help build these plants? That's the challenge. And it's well talked about, but I think fuel buyers should be more proactive, helping encourage that price to rise to help new production come online. But, they're in a tough predicament too. They're under pressure. Their states or wherever they're located are trying to say, look, we don't want expensive electricity costs. You've got to keep the costs down. So as a result, they're cautious not to, they bargain, they try and get the best deal. But that forward thinking really needs to come through in this industry. And that's why I think this price has still got room to grow and to overreact.
Do you pay much attention to some of these catalyst sentiment kind of mean? I do and I don't.
I mean, it was only 18 months ago that AI and data centers became the new talked about topic in uranium, and how all these new uranium mines are needed, nuclear power plants. And there's no doubt it's been a hugely positive influence on the sector, like Microsoft, and even seeing 3 Mile Island, coming back into production, which is, astounding. Who would have thought that would happen? So, Palisades, for example, you've got Dwayne Arnold. So a lot of these projects coming back on to support the AI data centers. And it's hugely positive. It's clean energy. So that wasn't talked about. But there's another catalyst. But I keep going back. The demand-supply deficit that was there before is still there and growing. It's just that, okay, now the market's focused on the next thing. And it captures attention, and suddenly generalist money and ETF starts flowing in. But yeah, I just wish it was more on a platform of stability, functional stability. Yeah, which we're missing.
Well, I think the key driver is to have a reliable base load at prices, reasonable prices. Drive those prices down, because we're all suffering. Certainly here in the UK, we pay 4 times the energy prices of anywhere else. It feels like, it's pretty nuts. It's pretty insane, right? So we want that kind of stable price, stable supply, security of supply, all of that kind of good stuff. But it just, as it has been certainly since I've been back in the space the last 5 years, very sort of disjointed, discombobulated planning, and a lot of variables which out of everyone's control, it seems. But
we'll talk about Australia and the political handball that nuclear power is, because boy, it's going to be a big election issue come May. But yeah,
well, for you guys,
long-term thinking, where is it?
Yeah, for you Aussies, I think obviously, I know you say in one of your marketing materials it's Australia's more uranium friendly. It's like, we, maybe to varying degrees, but if Labor are outed, I think it's probably good news for Australia, for sure. Not just on the mining front, but actually maybe creating a nuclear industry for themselves as well. But we shall see. These are subjects for another time, Duncan. We've got to stick with this business model of yours, right? So, okay, producing pounds with contracts, ramping up, etc. So, talk through the kind of ramp up phase of this. Where are you at the moment? Where will you get to?
Sure. So the ramp up's quite gradual. It's £850,000 for the first year, which sort of takes us to June 2025. Then 1.6 million to June 26, onward to the nameplate at 2.45 June 27. So the ramp up's gradual. It's really bringing new well fields on, and then sort of expanding our production throughput. So, you sort of, I guess, with an ISR mine, and by restarting the mine, it wasn't just simply turning it back on. We changed the whole front end of the plant to adopt ion exchange and did away with solvent extraction. So we're now at a stage that the first 3 of 6 columns are installed and operating for ion exchange. We've got another 3 columns 4, 5, and 6 to install and commission this first half of 25. And meanwhile, we're developing well fields. But yeah, as the ramp up continues, hopefully come third quarter this year, the plant's running effectively. I mean, we'll keep trying to work on efficiencies, but you then switch focus to becoming more a wellfield development type company. So focus on bringing new wellfields. As one depletes, you bring one on, and I guess that becomes it's almost like an open pit, how you clear out more land and here you develop new well fields, and that becomes the focus. Yeah.
Okay, so it's predominantly kind of OpEx development and a little bit of CapEx in there. Is that
a bit of sustaining CapEx for those well fields?
Yeah.
That's
okay.
So at the moment we've got clear runway. We've got about 18 months of well fields that have actually been established and developed, and we know how that's going. And the focus has been recently on the processing plant. But yeah, it'll switch back to well fields, and you always want to be sort of 6 months in advance of when you need a well field. So you're always prepared should something go wrong, or if you need to increase your production rate. So yeah, that becomes the new focus. And yeah, so far so good. I mean, it's been a good start for us, but it's a gradual process. It hasn't been easy by any stretch, and we have to keep working at it.
So, and what's that look like going forward? You've talked about a sort of 10-year life of mine, but you can obviously open up additional fields, and you look to continue to expand the kind of pounds in the ground component, but more importantly, getting them out. So the next 2 years or so seems like we're putting money back in the ground or putting the money on the ground, but the money making bit where you start to really kind of see a decided increase in that potential to free cash flow. When's that kind of kick in for you?
I guess it's really going into next year, 2026. So that's when it really starts to look after itself. We're lucky we've got quite a large carried forward tax position from the previous operation, so we've got some benefit this year, not really paying tax at all. But yeah, it starts to really generate from 2026 onward. So yeah, and then what to do with those funds? I mean, we're hoping that we can grow and expand, of course. I mean, Honeymoon's been our focus, and the board's been very disciplined on me to make sure that the flagship asset works as it should be. But yeah, I'm aware that you don't want all your eggs in one basket. We do want to expand, but it's tough, Matt, finding and looking out there and where are the other projects and do they stack up and can they be economically viable? It's not an easy. It's not like there's a big playing field of available projects, but we're not limiting ourselves to ISR. If it goes back to open pit that I'm familiar with, that's good too. Underground, White, our chairman's done. So yeah, we're open-minded. It's just the timing. The timing has been Honeymoon getting up commercially. We're now getting into that next sort of field. But yeah, there's still a lot of work to do to get Honeymoon.
Okay. Yeah. So Honeymoon and organic growth, obviously front of mind, and you're referencing there, but M&A, when you're looking around the market, presumably, given your kind of cash position and given your producer profile, you won't be looking at exploration projects. You'll be looking to sort of
sorry, I should have said, organically with at large acreage, and we've got 2 satellite deposits that we're looking to bring on.
Sure.
So we've got organically we want to grow, and inorganically M&A look at those options as well. But yeah, the timing's everything with these value accretive, etc. So yeah.
No, sorry, I kind of parked up. I assume you're going to be doing organic growth at Honeymoon for sure, and and again another time we can talk about budgets and targeting and approaches there. But just in terms of the M&A type activity, we are seeing across the market in all metals a bit more M&A because there's a lot of cash constrained companies who just may have a good asset or not, but they can't move things forward, and they're sitting there stranded waiting for either a change of business plan, access to capital through JVs or selling or whatever they want to do. So there must be a lot of options on the table, but is it a case there's a lot of lipstick on a pig out there, or do you think there are some possibles, but maybe the pricing isn't right? I mean, what's the look like?
I think it's a bit of both. I think there's definitely lipsticks on pigs. I think there's optionality as well. There are projects that look really interesting that I think could be better financed and some help from a technical perspective. And I think there are jurisdictions too that one would like to go into, but the government or the regulatory hurdles are too high. So there are opportunities out there. It's just a matter of staying abreast of them and doing the work, doing the due diligence, and hopefully they work out. I mean, we've had a good look at several in the past. Like Encore, Alta Mesa, we're really happy with that relationship. But yeah, it's there's a whole bag of tricks, and you kind of go back to the last cycle. What were they? Sort of 200 plus listed uranium entity companies on the various exchanges, and only a few actually went into production. So yeah, now we're seeing the same assets come around with a brand new name, new management, but it's the same resource. Yeah. So yeah.
I want to be clear, because I always say this to people that said, like, I think there's a lot of companies out there and with assets which, quite frankly, industry knows will never work. It hasn't worked in the past, won't work in the future, but it's distracting. It's taking money from investors and maybe diverting it from investing in better companies like yourselves. And I don't think that's good for the industry as a whole, because there's only one inevitable outcome there. So when you're looking around the market at the moment, lots of people do you see lots of people jumped on the bandwagon? Do you identify and you understand there are projects there which perhaps are suboptimal? Do you accept that?
I mean, we've seen a few examples of companies taking scintillator readings and putting those readings up, which they look enormous and lots of zeros and think it will grab market attention. But yeah, that lack of sort of discipline or code of conduct confuses the potential shareholders and investors. I mean, it's challenging, Matt. It's not easy. There's not a lot of projects out there that really at the moment have this ability to develop into being a going concern and producer. It's resource dependent. It really is. So what's pleasing, I must say, recently is that new talent is coming back into the industry, and there's a lot more youth engaging in uranium mining. And, you know, part of our stewardship within the industry, and Brandon Munro and John Borshoff and, you know, Greg Hall and Mark Chalmers and, you know, gentlemen like that, and Paul Corinson and Bill. I mean, they're really putting time into some of the more industry events and conferences to bring that new talent. And I think that's what's needed. So, hopefully we do build up that expertise, and suddenly these, you know, hopefully that effectively pushes out some of these sort of Johnny-come-latelys into being, right, here are real projects, here are prospective projects. They may need a higher incentivized price, but when they get there, they're good to go. That's the hope. And
just finish, I'm so conscious of time here for you. On a Friday night in Australia, is you got better things to do. Is what do you want to be? What am I buying into? You're going to be a producer. You've got 30% of Alta Mesa. You've talked about M&A, but what are you building here?
What we want to do is be a credible producer. We really want to deliver on our word and produce as we say we will. We want to build a solid footing and be corporately responsible and really deliver returns to shareholders and stakeholders alike. So by that, what's the next step? Hopefully we can find more satellite deposits and bring them in through that organic growth, or through mergers, acquisitions, and we grow and we try and, you know, throw the egos out of the room and really look to work with like-minded people and sort of grow and become a cash flow producer and bring some sort of stability in production. That's the goal. If we get there, great. We're doing our best to get there. We'll keep trying.
Cash flow producer. That's so old school, isn't it? Unbelievable.
Yes. That's why we
it's just so many companies
do it, right? To make money.
I know. It's so many companies forget to do that when I'm talking to them. I'm waiting for them to say, make money. But well done, you. I like it. Look, Duncan, go off and enjoy Friday night in Oz. We will see you again soon. Thank you, sir.
Thanks, Matt. I'd love to come back. Thank you. Thanks for your time too.